Let's go into the residential market update with me, Jackson Pino, your association's policy and research specialist. We're gonna have a slightly alternate style of presenting today. Like I said, I want to make sure that I leave time for you to ask questions and for us to actually engage in the tools that I use to make this presentation that you guys can use on a regular basis to really understand the market dynamics for the type of business that you're running. We're going to play around with that. Mostly it's going to be InfoSparks. And that hopefully will show you how to catch fish rather than me handing you a fish, as that old adage goes. So we're going to start with those short-term market updates and make sure that everybody is aware of the latest and not so greatest of what's going on in the housing market. Then we'll take that longer view and go into our annual charts. And then because it's really timely right now, we're going to focus on inflation and federal interest rates. What does that mean? Get a fundamental understanding of that, because I truly believe a fundamental understanding of the market conditions will help you understand how to take advantage of changing opportunities like yesterday's federal hike of interest rates. What does that actually mean for you, right? And then finally, with that last few minutes, we're going to explore market research tools. Sound good? You know what I just realized? I'm not sharing my screen. You guys can't see this because I usually let David share his screen. Let's share my screen so that way you guys can take a look at that, right? All right. Let's pull back open that chat so that way I can make sure everybody sees what I can see. Wonderful. One last thumbs up. Can you see today's to-dos and those 4 bullet points that I reached out of the ether and said? Wonderful. Thank you, John and Jesse. And without any further ado, let's move on. So this has been a roller coaster of a year, right? And some of you probably like roller coasters, but if you're anything like me, not a fan. Not a fan of the drastic changes of the highs and lows of the past couple of years. And although it could be fun, it's terrifying, right? And that most terrifying part, we all know, is when you get to that highest point in the roller coaster and you're about to go over that crest and fall. And that, I think, is a really solid analogy of where we're at right now in terms of our marketplace, right? It feels like we're at that high point and we are diving. Homes aren't selling like they used to. The buyer competition is not there. And like any other rational human being on a roller coaster, you look down and you get bug eyes, right? You get this kind of bug eyes, right? And it's natural. You are seeing drastic changes, and if you don't really know how it's going to change, you end up freaking out, right? That's why you're here. Don't be this kid. Understand that we have a market dynamic in the context of a greater perspective, right? We are in a seller's market. We know what that means, but just in case you're new here, the idea is if nobody put homes on the marketplace today, how long would it take for our current inventory to sell out? And if it was a balanced market, like an equal number of buyers and sellers, that would take about 6 months. We like to say 4 to 6. This keeping current matters, and NAR source document says 6 to 7, but definitely 6-ish, right? And we're at about 1.7 months supply of inventory. That is huge leverage for your sellers. We've been like that for the better part of a decade now. Yes, it looks like we're falling, but we're falling relative to the most extreme sellers market that we've ever had in our careers. So that context is really important. So let's think about that context while we're talking about the fall that we have seen relative in the short-term market, right? First thing, the elephant in the room, the drop in pending sales, right? This is a chart that shows a trend line of purchase agreements on a weekly basis over the past 4 years, starting from the back in 2019, that faint gray line, then in a lighter blue line for 2020, a darker blue line for 2021, our last completed year, and then our current year at 2022. And as you can see, 2022 has definitely been a lower performing year than the past 3 years prior, including 2019 before the pandemic and the economic impacts thereof. This looks like that crest, right? But we need to keep in mind that performance like this is a trade-off. That big push that we had in 2020 and 2021, especially in the later quarters of the year. See how high these charts, these lines go in the chart? That is that huge fever pitch levels of demand that we saw in the past 2 years. And those people have homes now. Now they may have considered buying a home in 2022, but they ended up getting it in 2020 or 2021. They're not here now to buy that home this year. It was a trade-off, right? And we're experiencing that. Where are we experiencing it in particularly, right? Definitely across the board, as you can see, broken out by price point. This is last week's pending sales, their signed purchase agreements, and the difference between the number of signed purchase agreements last week and the same week in 2021. And we are down almost 31% across the board in terms of pending sales for that week. And it is worse the more affordable you get, roughly. Yes, there's a big 50% boom in the most affordable section, that under 120,000. Looking into the numbers on that, because I was surprised with it too, it's an increase of 4 homes that were sold in this week of 2021, 6 homes that were sold in this week of 2022. That ends up becoming a 50% increase, but it's a really small number, right? The hundreds of homes that were sold relative to the $250,000 to $350,000 mark, that is a lot more reliable. So let's just not look at that last left bar. Generally, we're down across the board, and it is harder hitting in the more affordable properties. What precedes that, right? Because we always want to make sure with this, we're giving you the most up-to-date information possible. We like to say here that your showing activity is going to be an indicator for your buying activity. And that this is a way that you can, as you just asked, Sarah, kind of get a peek into predicting these changes. The showing activity is going to give you the closest look of what this next week or next month's pending sales are going to look like, right? So showing activity looks really similar here, right? We have lower showing activity across the year, and that is something we really anticipated, because how can you really compete with the incredible showing numbers that you saw in the year prior? And another way of looking at this is the showing activity in absolute numbers. And as you can see, each of these blue bars, which shows showing activity in the prior year, broken out by each of these price ranges, is a little bit higher than every other gray bar, which is our current previous week, right? So that same drop in almost every category, the keen-eyed of you might notice that the luxury market is seeing gains. Sure, it's not the same numbers. We're in the hundreds rather than the thousands for our median priced areas, our 250 to $400,000 range. But luxury market's still getting an increase in showings. If that's your bread and butter luxury market, then keep an eye on that. They might end up switching and joining the rest of the price segments in being negative in the coming months. But right now, this is a positive for you and your buyers or your sellers. Overall, though, showings is down about 10%. If compared to what we were saying, down 30% in pendings. Yes, we're likely to see the next week, maybe the next month, be down relative to the year prior. But hopefully, if the market conditions allow for it, it won't be as drastic a loss as what we saw. So let's take a look at new listings, right? And this is getting into our more annual charts, right? We have in each of these charts that I'm going to show you here, looking back as far as the data will allow. I want you guys to be able to see that historic trend over time, but we're going to be focusing on those last far right columns because that's going to be what you're feeling right now in the field, right? And as you can see, over time, our new listings, an indicator of supply coming into the marketplace, has seen a relative drop from this November compared to Novembers past. As we were, coming up to what would become the pandemic, we were seeing some incremental growth up, and then when the pandemic hit, that growth started to accelerate a little bit more, 2% increase for this November month for each year, but not this year. A decrease, right? 16.8% decrease over time. It's noticeable. There are fewer people who are willing to get into the marketplace, right? Why are they less likely to enter a marketplace? They have a home, it's selling for a good price. What's going on, right? It's the same story going on here. This is looking at the year overall. 2021 and past is that completed amount of new listings throughout that entire year. 2022 is just missing December, right? And even though we still have a month to go, we're definitely not going to have 10,000 homes in the marketplace. We're probably not going to break even. This is going to be a lower year in terms of annual new listings. And why, right? It comes down to pending sales, right? Because everybody who is considering selling their home, unless they have another equally livable home to move into, they have to be a buyer as well, right? And it doesn't look great for buyers. We'll get into why in detail, but you guys already have a sense of this, of exactly why. Interest rates and how difficult it is for them to have their dollar stretch compared to how it was in 2020 and 2021. You can see it very clearly, this positive increase as we go into the pandemic, and then a sudden bump, a 20% increase from 2019 to 2020 in November, guys. That's insane. And sure, a bit of a decrease. No, that was an increase. This percentage is wrong. A little bit of an increase. It's definitely a 1%, 2% increase, but then a major drop. In fact, in November, our official number that came out in our press release earlier today is actually a little bit greater than this. It's a 40% decrease. That is the single largest year-over-year decrease that we have had in any given month in the past decade. That is showing you the degree of how our market has shifted and our unwillingness as a buyer to go into this marketplace given where we're currently at, right? Again, this is the crest of that roller coaster. It looks scary, but I guarantee you understanding it and understanding the implications for how we came here is going to be the important part, right? So moving forward, yes, pending sales, again, from an annual perspective throughout the entire year, we're down 22% relative to the completed year of 2021. We're definitely not going to get another 10,000 purchase agreements signed sometime in December. So look ahead for the end of the year for us to be down in terms of pending sales as well. Closed sales, very similar story. You can see it even more clearly here, that flat, stable, half a percentage, a little bit more growth from one year to the next, a sudden boom, and then a drop off, right? What are we seeing here? And I think this is a clear way to see that trade-off that we're talking about. If you were to imagine cutting that bar off at the same level as our stable line here, a good portion of these people would have eventually, in the following year, ended up buying a home in 2022, maybe a little bit more, right? There's definitely enough to squeeze in the difference, that 38% that we're missing, right? They chose to jump early, and now they're not jumping because they have. Sarah, you said back in 2015 volume with more agents sharing the pie. Yeah, there is an aspect of this of concentration, of sharing the pie, as you say. And we have seen a major influx in members because of this. Look at this, how enticing this is, the number of closed sales. That certainly plays a part in that role. Let's hop into, yep, annual closed sales. Same story here. We're definitely down, and we just talked about why, right? But a silver lining in all of this is we have an inventory increase. Remember, we're talking about these drastic drop-offs in demand, right? Demand's changing, supply also dropping, but relatively less so. And the end result of that is that we have more homes left over in the marketplace. And another way to look at that is that our market is becoming slightly more balanced. We have inventory numbers now that are positive. We have had positive increases. Let's count them: 1, 2, 3, 4 times. Let's not even count the fourth because that's pre-recession. 3 times in November since the recession hit us. Prior to the recession, yeah, we were creating an inventory bubble. That's very clear right here. But our inventory has been steadily going down as our economy in this area has grown. And because we're seeing the decrease in demand relative to past couple years, we are at least filling that proverbial tub up. Our gas tank of homes is available for people when they come to the market. And that is good for us. There's inventory to sell. This is now in context of the ratio of inventory to demand, month supply of inventory. And we are considerably up. We're at about 2 months supply of inventory. And that is not something we've had since the beginning of the pandemic. Not just in November, but I can tell you pretty much any month since the beginning of the pandemic. It started dropping about summer of 2020 to below 1 month supply of inventory and really hasn't gone much above that since. This is an intentional corrective effort that is the result of monetary policy, which we will definitely get into. But just finishing up the individual long-term market charts for you here. Days on market, because there's less competition from buyers. Homes have a longer shelf life. It used to be that homes were, selling at a height, in a week, less than a week. We're now seeing something come back more to normal, about 24 days, an average. I believe it was somewhere around 35 to 40 days. So set expectations for your sellers now. They're not going to post their home, up on MLS and get 40 offers over asking price by the end of the week anymore. That's not going to happen. Speaking of, um, uh, yes, annual days on market. This is the total, not just for November. Similar story, but incorporate that lower number because hotter seasons breed hotter housing markets, right? But let's talk about price, and then we'll jump into the idea of over asking price, right? One other major positive in all of this is that we are starting to get control over inflation. We're going to dive into exactly what that means, but right now in the practical context, think of the idea of our median sales price of the median home, and how drastically it's grown over the past couple of years. Look prior to 2020. We're seeing, apart from a couple jumps here coming out of the recession, we're seeing pretty consistent positive growth. That's a good thing. That's reliability, not only for your buyers, because they understand that a home's going to cost a little bit more next year, but not too much more. But from your buyers, from your seller's perspective, if they have property value, they want to make sure that it's reliable property value, not that it's a 20% increase one year and a 30% decrease next year. Stability and reliability in home values is one of the most valuable things. That's the reason why people take out 30-year mortgages, right? Um, uh, let's talk about the idea of that 10% increase that we saw in 2020 and 2021. That was great, right? It was wonderful to be part of that process, but it also made it a lot more difficult for some people to own homes, right? It set that bar, that absolute sticker price high, and now we're starting to see the uh, the decrease in price growth. Now that's different than saying prices are falling. That would be bad if prices were necessarily falling, but the rate of growth of prices is starting to stabilize back to what we saw prior to the pandemic, prior to that inflation. And Sarah, thanks for asking if we could check in. I'm happy to answer any questions as we're going along. We're about halfway through, so I'm not going to pause for any check-ins, but if you guys have any questions, type them in the chat. I'll try to incorporate them as we go along. So that annual median sales price, now keep in mind, this is November's sales price. This is all November's comparatively. Annual median sales price across all seasons, right? We're seeing that double-digit increase that we saw from 2020 to 2021 go away. We're back to a 7% annual increase over time. That's a good thing, right? But with the decrease in price growth is, again, that managing expectations from your sellers. Your sellers, I'm sure, are still in that mindset of saying, well, I always hear that there's a low inventory and prices for homes have been going up dramatically. I'm getting 4 or 5% over asking price, right? Like, I'm definitely going to get that, right? No, not anymore. In November alone, we started seeing people negotiate for their homes on average. 97.2% was the average price relative to what was listed, that people ended up closing at. So please set those expectations for your sellers that if you want to invest, put some capital into your home, update that bathroom, or redo that front entryway and then sell the home, sure, you can definitely see if you can get competing offers and try to get above listing price. But I don't think you're going to start seeing, even in November, we were getting slightly above asking price. Fourth quarter sales like that normally don't happen, right? Look at all previous years. This is the time to negotiate. And in our 2 pandemic years, not necessarily the case. We're back to that normal now. And throughout the year, we're still at just above asking price, but it is going down. Negotiations are back on the table. Now we can talk about inflation. And since you offered, Sarah, I'd be more than happy to, if people have a question or two, or I went too fast, you want me to explain something in those charts, because I know how much you guys love the charts. I'll pause for just a moment, take a sip of my Coke. If not, we'll go straight into inflation. It's going to be a fun one. All right, no questions. Let's talk about inflation. So they say, and David loves this slide, they say economists have predicted 17 of the last 3 recessions. That's a good one, right? And that is, put simply, the idea that it takes time for us to actually measure the idea of a recession, because it takes time for us to measure inflation and the impact that our buying capability has on the economy. From buying homes to buying groceries, it all has an impact on how much our dollar actually goes, like how much we get for our dollar, right? Warren Buffett once said, in a recession, it's important to be really good at what you do, specialize in something, become a student and a scholar of the market, look at how it moves given different dynamics and changes in rates, and become that market expert that so many are asking for. And that's why I'm bringing to you this kind of like teachable moment about inflation, because I want those of you who show up here to be what Warren Buffett is offering here, being that scholar of the market. Because if you truly understand what's going on here, you'll be able to make lightning quick decisions off of your business, because the housing market is so closely tied with the banking relations in interest rates and inflation. You all know this. And so let's understand it fully, right? And the best way to understand it, I think, is penny candy, okay? Y'all know penny candy, right? You all remember penny candy. I don't, because I'm a millennial, but I think it speaks to the idea that it's so pervasive. Someone who grew up in the 90s still understands what penny candy is, right? This equals that. And that is great, right? Except it's not great. That doesn't happen anymore. We don't have penny candy anymore. Why don't we have penny candy anymore? Why do the prices of goods and services change over time? And we blame it on this thing we call inflation. But what is inflation, right? Why is a Tootsie Roll no longer a penny? Price reflects supply and demand. That's some of the basic stuff that we kind of hear about all the time, right? But yes, the price of something reflects the amount that's available and how much the people want it, whether that be the homes that you are buying and selling, and cars, or small daily purchases like groceries and gas. And now it's a subtle concept here, but it's really important that everybody understands this, that price reflects not only the balance of supply and demand of the products that you're selling, but it also determines the balance of supply and demand for the money that you're trading in exchange for it. The idea here is that you have an intrinsic value of what that dollar is. A penny isn't valuable enough for that piece of candy anymore. Now the candy's the same, so the value of that penny has changed. That's why penny candy doesn't exist, right? And I want you to get into that idea that the dollar that you have before you is not a static thing. It is a token used to exchange for goods and services. It's a really good token because you can pretty much use it for anything, right? And that's why we demand it. Now, the demand side comes from us. The supply side comes from the federal government, particularly the Federal Reserve, which determines how much money should be in the economy in order for, in an ideal world, to perfectly balance how much we need money to get the goods and services versus how much money is actually there. So what does this look like if there's an imbalance, right? Because there are two ways to be imbalanced: not enough money and too much money, right? Not enough money is what we call deflation. You could have, let's say, $1,000, right? But those $1,000 relative to your costs of living, the luxury purchases you want to make, your amenities, your travel, whatever, everything you need to exchange that money for, there's not enough to go around for you. It's not enough to go around for everybody at an entire national level. And that's what we call deflation. And when there isn't enough money to go around, people start looking at their monthly bills and figuring out what's necessary and what do I need to cut. Sometimes cutting necessities, right? And it's not just people who do that. Businesses do it too. And they say, okay, what resources can I not spend on anymore? And that ends up relating to unemployment, right? And then when money gets so rare and we therefore value it so much that people end up stop spending on necessary goods altogether and saving it, because that saving of a high value product means more to them than the products themselves. And that is how you start recessions. That's what we're afraid of when we take away the power of we take away the amount of money that's in the economy, so that way it's so rare, right? Inflation is the exact opposite. There's too much money to go around. And when you have a lot of money and that money ends up burning a hole in your pocket, you end up spending. And it's no longer just the necessities, it's luxury items. It's let's get our kids those extra gifts that they want, but they don't really need. Um, you know, the value of that dollar essentially goes down. And when it happens to an extreme, that ends up impacting the businesses that supply those goods and services by way of emptying the shelves. Think the supply chain issues of computer chips and toilet paper in the past 2 years. In what, June of 2020, you couldn't find toilet paper in your grocery store. Why? Trees still existed. The companies that made the toilet paper still existed. But the reality is people valued that toilet paper more than they had value for the money that was in their pocket, and said, I'm willing to make that trade easy, man. And then all of a sudden, no one could buy toilet paper. That sort of disruption to our global economy happens when inflation is going on unchecked. Prices end up rising because of it. And more importantly, at a national level, it impacts our ability as a government to pay off debts, because that value of that dollar goes so low, and the U.S. federal government has debts that they can only pay off in dollars. And if those dollars are worth less, not worthless, but worth less than they were, then they have a harder time actually repaying those debts. And when you go to absolute extremes called hyperinflation, think countries like Greece and Venezuela, they end up forcing their central bank to to print money for them to pay off those federal debts, and their economy completely crashes. So we don't want that. That's worst case scenario, right? And those are our extremes that we deal with every day when we have a dollar and we think, what is this worth? Now, the government thinks that at the same time, and they think about it in terms of banks, our financial institutions, because the vast majority of Americans choose to not hold their money under, a sofa, but they instead let their money be managed by big banks, right? Whether it be a big bank, small bank, your money, although is yours, is not in your possession, right? Well, those banks end up holding on to that money. And they're savvy people. All major banks want to have money in reserves, but they want that money to work for them. They want to be able to gain more money by using that money. That is where the United States Federal Reserve comes in. And this is the big teachable moment that I hope is all connecting here, because we talk about the Federal Reserve and interest rates and how that impacts your buyers when they're thinking about buying a home, because it all starts here. The idea is that big banks end up investing their money in reserves to the Federal Reserve. And in exchange, the Federal Reserve gives them an interest rate, saying, you trust us to hold on to your customers' money, we're going to give you an interest rate. And that means that the higher the interest rate, a savings interest rate in giving money to the Federal Reserve, the more potential returns these banks have to save in the Federal Reserve rather than lending that money out to other banks, other people, businesses. And that is the exact rate we're talking about when we say the Federal Reserve hikes interest rates. They're saying, we want you to put your money with us, and if you put it with us, we're going to give you more money in the future. Now, that has a trickle down effect. Wells Fargo, just picking on them because they're the biggest name here visually for me. If they see an increase in the Federal Reserve effective rate to save with them, that means they got to make that money worth their while if they're going to lend it out to another bank or another business. Because, man, that rate of return is really good at the Federal Reserve. So they'll increase their lending rates relative to the effective rate of the Federal Reserve. That ends up impacting all the other small banks. Think your local credit union, your regional bank, whatever it is. When the Federal Reserve changes their savings rates, the banks that work with them, which are pretty much all of them, end up increasing the cost of doing business to use their money in other ways, i.e. lending. And that has an impact on us, both your clients, businesses, if you work in the commercial sectors as well, they all need to, take money out from banks. And when the interest rate to save at the Federal Reserve increases, that means everybody down the line wants to make sure that they're coming out net positive. And they need to make sure that the money that isn't going into the Federal Reserve is being used in at least a beneficial way. I.e. they're making more money out of it than they would putting it in the Federal Reserve. I am gonna put this on screen. I definitely hid the chat function for a minute. Does anybody have questions about that? I might even go back now that I have the chat back up. That was, overwhelming, and I know from a perspective it might be sounding like drinking from a fire hose. But does that all relatively make sense why we care so much about interest rates from a lending perspective? I hear no major questions. So sweet. I see a yes. Wonderful. So let's talk about what that actually means for you guys in practice, right? The Federal funds effective rate, that's the fancy name that they like to call the savings rate to bank with the Federal Reserve, has increased. And as you can see, over time, starting before the pandemic, we had let's just give a moderate, let's say arbitrarily, a moderate interest rate for banks to put their money in with the Federal Reserve, right? And then, wow, they fell right off a cliff in the start of the pandemic. Why did they do that? Put simply, they wanted to inject money into the economy. They knew that lockdown procedures were going to scare everybody into not spending money at all. And they knew that that would almost certainly cause a recession. So to combat that, they dropped their interest rates right down to basically zero and said, sorry, banks, you can put your money in with the Federal Reserve, but you're not going to get anything for it. So the banks said, okay, I guess we'll just use our money in lending practices instead. And since you don't give us incentives to save, we don't need to try to make that up with higher interest rates for any loans we put out. And that's how they ended up decreasing loans, the interest rates for loans. And it gives you a sense of if we didn't have a Federal Reserve, which I'm not recommending we have, that would be really bad. But like if we didn't have a Federal Reserve, interest rates would be a lot lower, right? And as that year and a half continued, we started to realize we overshot. We as the Federal Reserve overshot that idea. We put too much money out into the economy. We knew that because prices were skyrocketing. We were seeing double-digit increases in home sales, like we saw here in the Twin Cities. That's not normal. That's not sustainable. And it wasn't just big ticket items like homes and cars. It was everything. We all saw groceries increase. I remember avocados, increased 2-3 times the amount. Bananas stopped being 19 cents a banana and started being measured by the pound instead. Grocery items like that. It was everywhere, right? The value of our dollar was essentially going down. So in response, the Federal Reserve is trying to combat that inflation with very consistent and arguably drastic compared to how they have practiced in the past, increases in that savings interest rate, making it more enticing for banks to put their money back in to the Federal Reserve and get it out of the economy, make that dollar more rare, so that way people want to hold on to it, so that way they're not spending it on things that they don't actually need. And that is how, in response, banks end up increasing their interest rate, right? And that is the choice that your clients end up having at the end of this process. They end up weighing that value of a new home and all the intrinsic qualities that comes with it, with the now ever increasing price of interest rates, which results in the increase in their monthly bill. And at some point in this year, we experienced that trade-off. People decided, I'm going to save my money because the money that I do have is rarer and worth more to me than moving up to that new home. So that's how we got here. These blue lines, you can now think of them as money stretched further. We valued the money less and we valued the opportunity for a new home more. And that black line in particular is the opposite of that. People saying they don't, they can't, that's exactly right, Sarah, that the affordability, the level of affordability, because remember, affordability is just how much can I afford with the amount of money I have. That money was so much more valuable to them. They couldn't let it go. It was not a necessity, and so they're choosing to opt out of the marketplace. Let's talk about fixed rate mortgages in particular and how that's changed. You can kind of see a very similar line to that effective interest rate because they're so directly connected. We saw a decrease, not falling off the face of the earth like the effective rate was, but we did see a decrease from about 4.4% to a lowest of about 2.7% average for a 30-year fixed rate mortgage. And then as interest rates from the Federal Reserve started to increase, then banks started responding appropriately and increasing their 30-year, fixed rate mortgage to a peak of around 7%. That's something we have not seen in close to 20 years. And now we're starting to taper back down a little bit. This potentially could mean that the impact of increasing interest rates has been measured as, okay, it's working. Now let's ease off. Let's try to make sure that there is still enough money in the economy so that way that feeling, that demand for money matches the amount of money that's actually available. What does that mean in terms of monthly payments? Because I think Todd Walker, your past president of the association, said it best to me and David one time, saying this is a monthly payments business, because at the end of the day, the sticker price of the home really doesn't matter. It matters how much people are willing to afford at a monthly rate. And everybody has that idea in their head, whether they're buying or selling, right? And we can definitely see the increase that interest rates have had on monthly payments directly. From, this is increased over time. You can see a ramp up steady as we get into the pandemic. It's slight, but it's there. And then flat, completely flat until we got into January or spring of 2021. And then all of a sudden we start seeing increases. And in the later months of 2021 and the beginning of 2022, when interest rates really started increasing, that's when we see the increase in monthly payments. A 36.3% increase in monthly payments is something that will definitely stifle someone's ability to consider buying a new home. In terms of that idea of the share of how much they're able to spend on a home, this is the same chart roughly, but it's in perspective of how much are people of median family income willing to pay out of that total income for a median priced home in the Twin Cities. And as you can see, we have a bubble. We had a bubble back in 2006 and decreased right down to people's unwillingness to pay a certain amount for a particular, for a median-sized home. And that was steadily increasing as we got into 2018, and then dipped before the pandemic and continued to dip until we got into the depths of that pandemic fear. Right. And then coming out of it with the increase in interest rates, all of a sudden we hit back up to heights that we hadn't seen even back in the bubble of 2006. This is an intimidating number for a lot of people. 26% of their annual pre-tax income is going to a home. And a lot of that has to do with the price of homes because of inflation, mixed with the high interest rates that they are having to pay because of the Federal Reserve's choices, right? And I know I said it. I know I said it's worse than the bubble. So we're gonna just make sure that everybody's on the same page here, right? Do I think that this is causing a bubble? No, I think this is corrective monetary policy, and I can tell you why. Let's take a look at what David and I love to call the great mean reversion. The idea here is that in blue, we have average sales prices of homes in the Twin Cities. And the dotted lines here, red and gray, think of them as your year over year appreciation, right? And of homes. And it is the guardrails of stable price growth, right? The bumpers on your bowling alley, if you will. We, in 2006, as a metropolitan economy here, we're well above the higher guardrail. And average sales prices were inflated. That was our bubble. We ended up hitting a recession, and it brought average prices below that lower, more conservative year over year appreciation. And we've been climbing back steadily ever since. What this inflation has done has sped up a process that was already going to be happening. Eventually, we are going to revert back to being in between these extremes, and we're just about touching it here. Another way, we know that we are not overpricing the value of homes, essentially. This is what it's saying. So is it 2008 all over again? No. Practices have dramatically differed in terms of lending as well. Excuse me, I need to cough. All right. Ooh, the time goes by so quickly. We're almost done. 2006, the total dollars loaned out to people with below 620 FICO score was 376 billion compared to 74 billion just a few years ago. That was in the pandemic as well. Major shift in lending practices on reliability related to FICO scores. Cash out refinances as a percentage of all mortgages drastically dipped relative to before the bubble popping and during the pandemic. In fact, mortgage originations by credit score overall have dramatically decreased. Look at the share of this dark blue, the below 620, and even the below 660 group as well has decreased over time. Your more risky borrowers aren't qualifying for mortgages, but look at the number of people with excellent credit scores that are getting homes throughout the beginning of that pandemic. They bought homes with strong reliability to make good on the money that they're borrowing. So put simply, there's no way that this is going to be a similar bubble. And this is that opportunity for us to kind of wake up and engage a little bit. I know we're relatively at the end of time, so I'll make it an option for you guys. If you want to head out and you got something to do at 3 o'clock, go for it. But I'm happy to stay on for a few more minutes and actually walk through some InfoSparks questions that some of you may have. I know everyone's looking for resources, so I have resources for you, which I will leave on the screen right now. In case you're curious about them later, you can take a quick screenshot or a picture of them and come back to them later. And if you're heading out, thank you so much. I really appreciate you coming and listening to me for an hour. If you do want to stay on, I don't mind staying on for another 15 minutes or so and talking about InfoSparks and any questions, but I will only stay on if people have questions about InfoSparks. I'm not going to give you guys a InfoSparks credit class for free, you know? Yes, Jesse, that is a good question. And he asked, for those of you who aren't opening the chat, how do I create the charts used in the slideshow? The answer is with a lot of time that isn't worth your energy, but I can tell you and show you how to make similar charts in InfoSparks that don't have the same like Microsoft Excel format, but they're really easy to see. David and I just like bar charts in particular. But let's hop into that, right? Let's close out of this. You guys have had enough time to look at that, and don't worry, everybody, I'm gonna send you a copy of those slides as well. Let's open up that chart. Let's kind of go to the default. I had a great little thing about condos. If you guys want to hear about condos, that's an awesome place to start with all of this. But let's duplicate that, bring it over here, and hey, look, here's InfoSparks. If you don't know how to get to InfoSparks, it is your North Star MLS subscription. You log in, and it is under Tools right here, InfoSparks. You click on that, you are brought to this. Let's take the idea that you want to know inventory, right? Homes for sale. For the Twin Cities region overall, that's what it defaults as, homes for sale. And you just click on those two, make sure you're in Twin Cities, and you click on homes for sale, and you get a line chart that shows you the rolling 12 months. So the 12-month average, think of that as your annual perspective of inventory. If you want a detailed look at like month to month, there's a little drop down menu right here. See a little sum symbol. You can be brought to monthly. And look at that. Over the last 3 years, gives you every single end of month total that we had in inventory, right? I think what you're kind of looking for is like over time, like long perspective, how has like our inventory changed? How has our number of pending sales changed? It's almost the exact same thing as the bar charts. It's just a line chart instead. Bar charts, unfortunately, is formatted, only goes back a certain number of years. Can I make it a bar chart? I wish. The problem is with the software that Showing Time created, bar charts only go back 3 years. So if you're fine with 3 years, yeah, it only goes back 3 years. Believe me, I wish it went back to the maximum. The data's there, because if you go to 3 years and you can hit max, you can get it all the way through. But if you're a keen person, and you're kind of willing to go into Microsoft Excel, hit the share button, go to CSV, and you can download the same information. Ready? And it's all right here. And you just highlight all of the data that you have, and you click Insert Chart. If you really, really want it in a bar chart, here it is in a bar chart, and you can kind of see why they didn't go with a bar chart. So that would be how I would make this, and that's how I make these charts. I start off with this, and it gives you all of it for each month all the way back to January of 2005. It's there. Now, making it clean and presentable for you guys here on this webinar, that is a different chore, but you can kind of get the gist of how I go about it. So Steph, I hope that answers your question. I gave you the example with the idea of inventory, but you can basically do it with any of the, close this, right? Any of the metrics here at the bottom. Let's see, I love InfoSparks, but the 3-year bar chart doesn't seem to give enough context. And I agree with you guys. We'll try to talk with them about that and see what their capacity is to try to change that. Do you have a simple way to just narrow it down to November of every year? Jesse, are you talking about in the context of that Excel workbook that I just closed out of and that I'm gonna open back up again? Correct. Okay, let's look at it again, right? Was this it? This was it. Okay. All right, we're getting admittedly, we're getting into a really nerdy part of Excel, okay? But I feel like Excel skills help you guys become the numbers ninjas that we really want you all to be, right? So what I did just there was I highlighted the two cells, right? Date and Twin Cities region for inventory, right? I now want to turn those into filters where we can just look at November, right? If you click on data, you see a filter button right here. You click on that filter button and you can see these drop down arrows just were created. And now this is it's kind of a dynamic filtering process. If you click on the drop down arrow for date, and you can see, it might be hard to kind of visualize it with my screen as it is, but you can see there's each of the years listed, and within the years there are months. And so if I just type in November, hey, look at that. The November for each month is checked. If I click OK, that gives you just the Novembers, Jesse, that you're looking for. And then if I wanted to have it just for November's, copy, come on, Z. Doing this live for you guys is always fun. High risk, high reward. Why is that not working? Control Z. Can I paste those values? No. This is frustrating me. Normally you can just, because there's filtering here and that, see how it's skipping numbers. You want to make sure that you just get these in a chunk together. Let's see if this will work. If I go insert chart. Yeah, it does. Okay, that's great. So now you don't even have to try to copy and paste it. You can just make the filter as is, and then make a chart, column, Twin Cities region. Hey, look at that. Now the problem is it does say January. You need to change this to November, but this is all the November data. So I hope that like that's a deep dive, Jesse. I'm glad you brought it in. That's how I would make these charts. Okay, 3 quick ones from Mary. Are there plans to add additional markets more than 4? You're talking about the locations. I think they've played around with that before, right? So we're go to 4, and it kind of intuitively looks like you could add a 5, you could add a 6, right? I think there is some sort of background, like back end capacity issue. If it's more than 4, it takes a hard time to load all of these different things. So I think we can ask and we can see, because they did kind of change their systems a little bit. I'll put it on the list with, can we get bar charts go back further than 3 years, and just see what they say. When comparing, is it best to leave the default price ranges or use the same price ranges across areas? I think those are 2 different things. One, most importantly, whenever you're comparing things, always make sure that you're using, if you've established whatever the price ranges are, whether that be the default ones that kind of look like a little random, stick with those, or establish clean ones. Like I love to, just do, this to 249, 250 to 499, 500 to 749, and this is arbitrary. You don't have to like go exactly with this. Don't read it in as Jackson did this, so therefore I should always do it. But I like that that breakdown. It seems clean to me, so I use that breakdown. But if I commit to that, then I'm not all of a sudden going to the default when I'm comparing with a different town or a different property type or something. And then your third question was, is there a quick way to download active links for all reports? I believe right now it's report by report. Mary, could you elaborate a little bit more on what you mean by reports? Dynamic links. So the dynamic links here and sharing is, I assume when you say here, like keep it live. Static means it's gonna just take a screen caption essentially, and live will update it. And you're saying like this sort of report here. Can you download active links for all reports? I'm not sure you can. And you're talking like download this and all the other ones that you've created over time. I'm not sure, but put your email in the chat, Mary, and I will see if I can get an answer to you. And don't see any more questions. There are 17 people left here. We're 10 minutes over. Do we have any other questions about either InfoSparks? I can play around with a few key concepts. All right, Mary, I'll copy your question right now and try to send you an email back later. All right, everybody. Yeah, we're past time and people seem to be happy with where we're at. So thank you all. If you do have any questions, I'm going to put my email in the chat so that way you have it. It's all in caps, but doesn't need to be. David Arbit jumping in at the last minute. Thank you so much, David. I hope you had a great prep meeting. And we'll see you all in the new year. Take care, everybody.